Welcome to the Investors Trading Academy event of the week. Each week, our staff of analysts and educators tries to provide you a better understanding of a major market event scheduled during the next week. This week, we will focus on the upcoming Federal Reserve meeting scheduled for March 17 and 18th. Policymakers are reviewing the outstanding jobs report released on March 6th, the last one to be released before the next Federal Open Market Committee meeting. While officials said in January they would be patient in raising rates, Fed Chair Janet Yellen signaled to Congress last week that their patience had its limits, laying the groundwork for a possible rate rise later this year. Federal Reserve Bank of San Francisco President John Williams said mid-year may be time for a serious discussion about raising interest rates as the labor market nears full employment and inflation rebounds. Williams said the economy is looking downright good and forecasts growth this year of just under 3%. The economy is showing solid momentum and there's good news in virtually every sector, he said. The economy could expand 4% if Japan, Europe, and China grew faster, he said after the speech. Federal Reserve Bank of Richmond President Jeffrey Lacker said Friday he is looking to the central bank's mid-June policy meeting as the most probable time to raise short-term interest rates. Given the performance of the economy and very robust improvements in the job market, June has to be on the table. Mr. Lacker was interviewed in the wake of the release Friday of very strong hiring data for February. Most Fed officials favor raising rates this year, with a number of policymakers pointing to the June Federal Open Market Committee gathering as the point at which officials will begin actively considering rate rises. Mr. Lacker, a voting member of the FOMC, was more direct in saying that June would likely be an ideal time to boost rates. The official also indicated that he favors moving away from the Fed's current pledge to be patient with rate rises, saying he'd like the wording to be struck from the FOMC statement in order to give officials more flexibility to respond to economic data. Pointing to the Fed's mid-March meeting, he said, "I think the upcoming meeting in a couple of weeks, just how we characterize the outlook for policy is going to be front and center in deliberations."